The Capital Markets Authority has submitted policy proposals to the National Treasury in regard to introducing new taxation measures in the financial markets. The authority wants the current taxation framework amended to accommodate new market products such as derivatives, asset-backed securities and real estate investment trusts, which are set to start trading at the Nairobi Securities Exchange towards the end of this year. KTN's Charles Gitonga reports.
Kenya's markets for buying and selling equity and debt instruments, commonly known as capital markets, has been termed as a goldmine for both individual and institutional investors due to the economy's growing need for capital. While for many years the market has been characterized by trading shares and bonds, the Capital Markets Authority and other stakeholders now feel the need to have more investment options as one of the ways to deepen the market. Some of the products planned for launch at the Nairobi Securities Exchange include the exchange-traded funds, which enter the market in September, while derivatives, rates and asset-backed securities are lined up for launch later in the year. To that effect, the Capital Markets Authority says it has submitted proposals to the National Treasury to have the tax regime aligned to the trade in the new products so as to protect investor interests. The proposals will ensure that funds are only taxed in the hands of investors and commercially inviable transfers will be tax exempt.
The proposals there relate to ensuring that the stamp duty and VAT chargeable and possible capital gains tax chargeable on those transfers, because ultimately those transfers have no commercial value. They're only there to establish the structure, which can also be considered for exemption.
They further advocate for a well-laid-out framework to administer the recently reintroduced capital gains tax on the products. Confusion over its collection had at one point seen brokers threaten to boycott if they were forced to collect the tax on behalf of the Kenya Revenue Authority.
Some of the proposals revolve around ensuring that, especially looking at capital gains tax, how that will be applied to derivative instruments, which are continuously required to be marked to market at all times, and to make sure that where there are gains or losses when you're marking to market, those would not be liable to capital gains tax.
The National Treasury has confirmed receipt of the proposals and are currently going through the budget process before approval.
But at this point, those are still going through the budget process, so we don't really have the answer yet. But I can say that they have been received and they're going through the normal budget process.
Charles Gitonga, KTN Business.